Welcome to today's Explainer. We are going to objectively dissect the actual mechanics of consumer debt. We so often hear debt talked about in these heavily moral terms, right? People frame it as a personal failing or just a necessary evil of modern life. But today, we're going to completely strip all of that away and just look at the underlying architecture. We really want to understand exactly how this system functions. Because depending on how it's used, debt can either be an incredible tool for generating long-term wealth, or it can be a mathematically engineered trap designed to totally derail you.
To understand why grasping this is absolutely crucial right now, consider this number for a second: $6,715. According to TransUnion data, as of December 2025, that was the average credit card debt carried by an American consumer. And the wild part? That number just keeps steadily climbing. We're living in an economy where relying on borrowed money has kind of become the risky, everyday norm. So understanding the system behind a number like this isn't just academic, it's a fundamental survival skill.
Okay, let's dive into this. Here is the structured path we'll take today. 1. The anatomy of debt. 2. The historical trap. 3. The minimum payment illusion. 4. The mental toll. And finally 5. Frameworks for eradication.
Section 1. The anatomy of debt.
Let's kick things off with how the financial industry actually views borrowed capital. You see, financial instruments are inherently neutral. The industry stratifies debt based entirely on how it mathematically impacts a borrower's net worth over time. It essentially boils down to this contrast. On one side, we have strategic, or what's often called good debt. This is capital you borrow to acquire assets that appreciate in value or generate future income. Think of a residential mortgage or subsidized student loans. These instruments usually carry lower relative costs, and over time, they build long-term equity. On the flip side, we have depreciating or bad debt. This is borrowing used to finance rapidly depreciating assets or discretionary consumption. A classic example is rolling over credit card balances month to month to pay for vacations or luxury apparel. With this, the borrower is paying a massive premium for items that immediately lose their value. It's a setup that actively drains your future cash flow.
But beneath even bad debt, there is a third, far more dangerous layer: toxic debt. We're talking about predatory financial products like payday or auto title loans that carry triple-digit annualized interest rates. And yes, they routinely exceed 300%. The thing to understand here is that these aren't designed to be short-term bridges for emergencies. They are engineered from the ground up as structural traps. The data is pretty clear on this. 4 out of 5 of these loans are rolled over or followed by a brand new loan within just 2 weeks. It mathematically predisposes the borrower to fail, practically guaranteeing that a minor emergency turns into a permanent state of insolvency.
Section 2. The historical trap.
Let's move to the history and see how this builds, because the architecture of predatory lending is definitely not a modern invention. We can trace a direct historical lineage of systems specifically designed to keep laborers trapped by ensuring their future wages remain perpetually mortgaged. Back in the 18th and early 19th centuries, we literally had physical debtors' prisons. Defaulting on your obligations basically meant a life sentence of poverty. And even though those were officially banned at the federal level in 1833, the core ethos absolutely survived. Just look at the 19th and 20th century truck systems in coal mining towns. Laborers were paid in company scrip. These were tokens that were only valid at the heavily artificially inflated company store. Workers literally couldn't afford basic survival needs, which forced them to draw credit advances against their own future labor. This system of absolute debt bondage structurally prevented laborers from accumulating savings or ever leaving town. Fast forward to today, and that exact same operational ethos is mirrored in modern fringe lending, using extreme pricing to ensure the borrower is always working to pay off yesterday.
Section 3. The minimum payment illusion. So how exactly does this trap function today? Well, it relies on a very specific mathematical architecture that transforms manageable, everyday debt into a spiraling crisis. Let me pose a question to you. Where does a minimum payment actually go? The reality is, credit card issuers engineer these minimum payments to maintain a psychological illusion of monthly affordability for the consumer. It feels manageable, right? But the whole time, that structure is maximizing the total interest extracted over the life cycle of the loan.
The real backdrop to this illusion is the underlying cost of the capital. In early 2026, the Federal Reserve reported that the average credit card interest rate on accounts carrying a balance was a staggering 21.52%. When you combine an interest rate that high with a low minimum payment, the math becomes incredibly hostile to the borrower.
And this brilliantly illustrates just how hostile that math really is.
Let's walk through a totally realistic scenario. Imagine a consumer with a $20,000 balance at a 21% APR. If their minimum payment is set at a flat 2%, they're sending the bank $400 every single month. But here's the kicker. The monthly interest charge generated by that balance is about $350. So out of the $400 remitted, a mere $50 is actually applied to reducing the core debt. The lending institution heavily enriches itself while barely touching the principal. And because that minimum payment is dynamic, meaning it shrinks slightly as the principal very slowly decreases, this repayment timeline literally stretches out over decades.
The terrifying velocity of high-interest debt is probably best shown by the rule of 72. Have you heard of this? It's a simple mathematical heuristic. You just divide the number 72 by the annual interest rate. So, if you have a credit card with a 24% interest rate and you suddenly couldn't make payments, that liability will double in size in exactly 3 years. This extreme exponential compounding effect is the exact mechanism that turns a temporary short-term cash crunch into a multi-year financial nightmare.
Section 4. The mental toll.
So the crucial point is that this isn't just about cold, hard numbers on a balance sheet. The behavioral economics here are fascinating. When someone is struggling under unmanageable debt, they enter a deeply researched psychological state known as the scarcity mindset. The human brain instinctively reallocates its processing power to focus entirely on an immediate deficiency. Like, for example, avoiding a utility shutoff tomorrow. This causes what researchers call tunneling, an involuntary hyper-focus on immediate crises. Under this immense, crushing stress, our brain's ability to plan for the long term is severely compromised. So making what looks from the outside like a quote-unquote bad financial choice, like taking out a payday loan just to cover rent, is actually a documented, involuntary psychological response to stress. It's a cognitive hijacking, not a personal or moral failing.
Section 5. Frameworks for eradication. Navigating out of this maze requires objective, defensive frameworks. Financial researchers note that the first step is always defensive. You have to halt the accumulation of new liabilities. Experts often point to tactile budgeting methods, like the cash envelope system. This strategy completely abandons frictionless digital spending in favor of physical cash, which basically forces intense intentionality into every single transaction. Next up is building a defensive liquidity buffer. We're talking about a starter emergency fund of roughly $1,000 to $2,000. Attempting to pay off debt without any cash reserves practically guarantees that the very next minor emergency, like a blown tire or a broken fridge, will force a return to high-interest borrowing. It completely restarts the vicious cycle. Once that defensive perimeter is established, any surplus capital can then be deployed to aggressively attack the debt.
When it comes to actually attacking the debt, there are two premier frameworks to compare impartially: the Avalanche and the Snowball. The debt avalanche attacks the highest interest rate first. Now, this is mathematically optimal. It saves the absolute most money on interest. But it can sometimes take years to clear that first large balance, which offers very low initial motivation. On the other hand, the debt snowball attacks the smallest total balance first, completely ignoring interest rates. While it is technically mathematically inefficient, behavioral economics strongly supports the snowball method. Academic research from institutions like Northwestern University shows that consumers utilizing the snowball approach are statistically far more likely to actually achieve eventual solvency and eliminate their debt. It turns out that securing those small, frequent behavioral victories provides the psychological momentum necessary to sustain what is often a multi-year, grueling repayment process.
Now, what's really interesting about this next framework is how experts value paying off debt versus investing. It's known as the 6% rule. Historically, once you adjust for volatility, risk, and taxes, a conservative expected return in the stock market sits right around 6 to 7%. Because of that, clearing a liability that carries an interest rate above 6%, like an 8% auto loan or a 22% credit card, actually acts as a guaranteed tax-free return on your capital. It mathematically outperforms average reliable stock market yields. Paying off bad debt isn't just about getting back to zero. It's genuinely one of the highest yield, zero-risk deployments of capital available to you. The architecture of consumer finance is a complex and entirely unforgiving ecosystem. As we've seen, it utilizes mathematical compounding to extract wealth efficiently. As we wrap up today's explainer, I want to leave you with one critical, provocative question to help you evaluate your own financial leverage. Looking at the capital you owe today, is your debt building your future, or is it borrowing against it? Thanks so much for joining me today, and keep questioning the mechanics of the world around you.